that have experience in both corporate and private investment management, wealth preservation, financial advisory, and so many other areas of interest. We do hope that we'll be able to open your minds to the opportunities that abound as we go within the session. So our agenda for today is the session is going to run for an hour. And with me, I have two very interesting speakers, one of which is Chinwe Egwim, who's the macroeconomist at FBNQuest, and the other, who is Adeyemi, who's also a portfolio manager at FBNQuest. Our first speaker today will be Chinwe Egwim. Just a brief profile about Chinwe. Chinwe is a professional economist with over 500 published economic notes, primarily geared towards development and macroeconomics. She's also an economist at FBNQuest and an active member of the African Development Bank annual meetings. She sits on the board committee on research at the Nigerian Economic Summit group. And because of her strong research skills and ability to process and extract value from data, she has been able to, we've seen her speak and moderate in high-level expert panels. Chinwe recently authored a book titled Understanding Economic Jargon. The book uses a simple approach to break down how economic indicators and the investment climate react to economic shock and upswings. Today, she's going to give us an overview of the economy, and she's going to be highlighting macroeconomics indicators such as GDP growth, inflation, foreign exchange rates, and economic projections. So before I give her the floor, note that we're going to have a Q&A session after the speakers are done, and kindly leave any question you have in the chat room, FBNQuest questions chat room. Please leave your questions, and we're going to take your questions after the speakers. So I'm going to leave the floor now for Chinwe Egwim. Thank you.
Thanks for that, Isabel. Thank you so much. So good afternoon, everyone. I will be providing a snapshot of the economy before we go into the granular details of the Eurobond fund. So may I have my first slide, please? Okay, so let's go to the opening slide, please. Thank you. So yeah, so the first slide shows a snapshot of what the Nigerian economy looked like at the end of 2019. At first sight, we see a well-diversified economy with the non-oil sector still accounting for about 90% of total GDP in 2019. However, in practice, the economy is still in need of diversification. Now, oil's direct share of GDP is limited to just 9%, but its indirect share probably is as high as 40% or more due to its many linkages. So what do I mean by that? Other sectors indirectly depend on the oil sector to grow. Nigeria is seen as a huge domestic market, the largest economy in Africa, and that is if we use the exchange rate on the INE NAFEX window, which I will get to very soon. In 2019, GDP at current account was about $398 billion. We can move to the next slide, please. So this slide gives an overview of what GDP growth looks like. we were emerging from an earlier recession, which took place in 2015, 2016. We were emerging with small steps, but that has now been torpedoed by the ongoing COVID-19 pandemic. Now, the latest data from the National Bureau of Statistics show that GDP grew by 1.9% in the first quarter of the year. Given the significant global disruptions triggered by the COVID-19 pandemic, this performance represents the earliest effects of the disruptions. So we expect to see more severe disruptions in the next quarter when they release data for Q2. Back to Q1, the oil economy grew by 5.1% compared with 6.4% in the previous quarter, which was Q4 of last year. Now, based on data from the National Bureau of Statistics, average crude oil production in Q1 was 2.07 million barrels per day. And this is compared to just 2 million barrels per day in the previous quarter. Meanwhile, the non-oil economy grew by 1.6% compared with 2.3% in the previous quarter. The major drivers in the non-oil economy were telecommunications, which grew by about 9.7%, financial institutions, which grew by, I think, 24%, construction, which grew by 1.7%, and of course, agriculture, which grew by 2.2%. So looking ahead, we see a contraction of about minus 7.4% year on year in Q2, reflecting the full effects of the twin shocks, which are, as I've mentioned, COVID-19 pandemic and oil price crash that we're currently facing or we've currently seen. We can go to the next slide, please. Next slide. So the next slide is inflation. And as you see, we have an arrow pointing upwards for all elements of the basket. That's the headline, the food, the core. The headline inflation rate rose from 12.34% year on year to 12.4% in May, according to the MBS report. Food price inflation picked up marginally from 15.03% to 15.04%, while the core measure accelerated by 14 basis points to 10.12%. Now, on a month-on-month basis, the headline inflation increased from 1.02% in April to 1.17%. The core inflation rate has now returned to double-digit levels for the first time since August 2018. The highest increases in core inflation were recorded in pharmaceutical products, hospital services, passenger transport by road, amongst others. And this has been the trend over the past 3 months. So, of course, the COVID-19 lockdown effect is therefore visible through this data. But I must mention us all that before the emergence of the ongoing pandemic, food price inflation rate was consistently trending up, mainly on the back of the border closure to curb smuggling from neighboring countries. However, the general supply chain disruptions across countries have worsened supply chain constraints. The expectation really, given what's going on, would have been to see generally lower prices to stimulate demand since pockets have been squeezed. But cost push inflation has kicked in during this period, hence the acceleration in prices. Our take, looking ahead, our take is that the headline rates will accelerate in coming months, with supply side constraints again being the primary reason. We see a further rise to 13.1% at the end of the year. Now the next slide. For some reason, I'm not seeing the slides. Can I please have the next slide? Okay, I'll just run along and I hope that you're all seeing the slides because I can't see the slides, so I'll just run along. So the next slide really represents external reserves. As for reserves, there has been steady depletion from June 2019 until April this year, mainly due to the exits by foreign portfolio investors. Now, the collapse of prices in March and April, all prices, to be precise, in March and April resulted in more depletion of the external reserves. However, gross official reserves recovered by $3.07 billion in May to $36.6 billion. This was the first monthly increase since May 2019 and can be traced to the disbursement by the IMF of the $3.4 billion soft loan it granted Nigeria within its rapid financing instrument. Now, the FGN has also sought COVID-19 financing from World Bank and the Africa Development Bank groups, which we refer to as multilaterals. As of yesterday, the gross official reserve stood at $36.1 billion. The current buffer against external shocks is 7.1 months of merchandise imports, but it reduces to about 4.3 months of import cover when we add imported services. So the next slide, which covers the exchange rates. For exchange rates, there was a change in direction in March, April 2017. This was forced by the oil price fall and FX shortages that had occurred in 2015 or that had kicked in 2015 due to the declining oil prices at the time. Now, there are new FX windows, notably the I&E window, which we also refer to as NAFEX. The principle of willing buyer, willing seller on NAFEX is acceptable as long as foreign portfolio investors are comfortable that they can exit if need be. However, that comfort has now been undermined by the recent crashing oil price, COVID-19, and of course, the delays with repatriation. Now, there were FX adjustments in late March this year as well. We saw an adjustment of 360 Naira per USD from 306 Naira per USD on what is termed as the CBN's official window. And also on the NAFEX window, which I just spoke about, we saw an adjustment from 360 Naira per USD to 380 Naira per USD. So recently, about let's say a week or 2 weeks ago, the FMDQ went live with an FX rate of 380 Naira per USD for the CBN official window at close of business last week, Tuesday, and has done so in subsequent working days after. Before this, about 3 weeks ago, the CBN had set a new floor of 380 Naira for the secondary market intervention sales, which is another window authorized to dealers for unselling to importers and SMEs. This was previously 360 Naira per USD. So these moves appear to be another step by the CBN towards FX unification. In our opinion, the authorities are moving in the FX unification direction, which was touched upon in their letter to the IMF when they were requesting for the soft loan under the rapid financing instrument. In addition, members of the Monetary Policy Committee have made the same point of unification in their post-meeting personal statements. Now, these steps are made with an eye on multilaterals, which the FGN has asked for loans totaling about $5.5 billion to part fund the 2020 budget. As I mentioned earlier, the IMF has come through or already given us $3.4 billion, but the World Bank and others are yet to disburse fully. Multiple rates are a particular dislike of the World Bank and the IMF, so perhaps unification will bring more disbursements, and help with funding the budget deficit. The loans are needed to replace departing foreign portfolio investors and so keep reserve depletion manageable. All that said, we expect that the CBN will continue to manage rates, deploy administrative measures, and make small FX adjustments when it has no room to maneuver. We see the FX rate at 410 Naira per USD in 2020, and this, I'm talking specifically about the NAFEX window. Next slide, forecast. Okay, yes. So this just gives a snapshot of our thinking with regards to specific economic indicators. So I'll just run through a few of them. For GDP, our expectation is a contraction of -3.1% at the end of this year. A modest recovery of 0.1% in Q1 2021, and then by the end of next year, we see it expanding by 2.2% year on year, hence returning to its pre-COVID level. Now for inflation, we see it accelerating to 13.1% year on year this year. the headline rate would have reflected squeezed demand, as I mentioned, and it could have fallen more rapidly had it not been for the many supply side constraints. And then these pressures have picked up even more this year due to the lockdown and disruption of supply chains. For the policy rates, we see the policy rate at 12% this year and next. The MPC trimmed the policy rate by 100 basis points to 12.5% at its last meeting. And the pass-through effect to the real economy from the policy is limited. For Bonny Light, we see Bonny Light is also all price. So Bonny Light crude price, we see it at an average of $37 per barrel this year. And in our view, the low point has been passed. And the challenge is the very substantial unsold crude in shortage elsewhere. As I spoke about official reserves, so I'll just speak briefly on that. We assume that the FGN will secure the full COVID-19 relief funds from multilaterals that they've sought. Our forecast for reserves is $29 billion, and we allowed for any pipeline of delayed external payments in place. So the next slide, please. So thoughts on way forward. So, with regards to moving forward, if you have FX related expenses, it is always wise to diversify your investment portfolio. FX related expenses could include imported inputs for business purposes, a mortgage outside Nigeria, school fee, or debt servicing in USD, amongst others. There's also the viewpoint of just preserving the value of your money if you earn in Naira, hence having some dollars safely put aside. So I repeat, diversifying your investment portfolio to include USD investments is something to consider, and our FBNQuest Eurobond fund is a good place to start. Thank you so much for listening.
So thank you, Chinwe, for that awesome presentation and for the analysis on the economic data, which you simplified for our understanding. Thank you all also for listening. Kindly note that if you have any questions for Chinwe, please drop it in the FBNQuest chat room, and we will be taking all questions after the second speaker. Now, this takes me to the next speaker. Our next speaker is Adeyemi Roberts. Adeyemi Roberts is a chartered financial analyst and an investment professional who works at FBNQuest. He's also a member of the CFA Society of Nigeria, and he currently holds the position of a portfolio manager on the fixed income team at FBNQuest. He's going to be speaking on the dynamics of investing in Eurobonds generally. He's going to touch on topics around features of Eurobonds, types of Eurobonds, Eurobonds within Nigeria and Sub-Saharan African, benefits of investing in Eurobonds, and opportunities for investing in Eurobonds, both direct and indirect invested. So I'm going to leave the floor now for Adeyemi to speak to us. Thank you.
All right, thank you very much, Isabel. And thanks to everyone that has joined us this afternoon. My name is Adeyemi Roberts, as she has already described. I'm a portfolio manager at FBNQuest Asset Management, and I manage the FBN Nigeria Eurobond Fund. So without further ado, I would just say, following what Chinwe has said, it's very important to diversify your currency exposure, especially in these uncertain times. But I will start by saying, now that you have, hypothetically, now that you have dollars now, what do you do with those dollars? Do you sit with your dollars in your domiciliary account earning nothing? Or do you invest in assets that can give you higher returns or competitive returns for your dollars? I would suggest that you go with the latter by investing in assets that give you, or assets or opportunities that give you an added return on top of your investments. So if you can just go on to the next slide now. So I'll start with Eurobonds, which is one of the options that investors have in order to gain competitive returns on their dollars. Eurobonds are financial fixed income financial instruments issued by governments, corporates, or supranationals in a currency that is different from a currency where the issuer is domiciled. So it could be in any currency. For instance, the Nigerian government has a variety of Eurobonds, all issued in dollars. So these Eurobonds could be issued in euros, Swiss francs, or any currency of the issuer's choice. And this gives, depending on, so the currency choice depends on the use that the issuer plans for the money and for the funds. So moving on to the next slide. So I've just given a brief introduction on Eurobonds, and now I'll go a bit deeper into the features of Eurobonds, how they work, and the usual things we hear about, or some of us may have heard about, and just to demystify some issues or terms that may not be clear to everyone before I proceed further. So when Eurobonds are issued, they are usually given a credit rating. Now, the credit rating is an assessment of the ability of the issuer to pay back. So issuers with higher credit ratings are expected to be able to pay back because they have the arsenal that's required, or they have the assets or the ability to generate income easier in order to pay back their obligations. So for example, in the United States, they have one of the highest credit ratings, and that's why the coupons on their investments, that's meaning the amount of interest they pay on their investments, is much lower. And a country like Nigeria, whose credit rating is a bit lower, so we have to pay more to entice investors to invest in our instruments. So that leads to the coupon rate definition, which is the interest rate that is paid on a Eurobond. This is an annual rate. It depends on the type of Eurobond. So it could be quarterly payments, it could be paid quarterly, semi-annually, or annually, depending on the issuer's preference. But in Nigeria, most of the Eurobonds we have are paid semi-annually. So at initiation or at issuance, the Eurobonds are issued at a price of $100 per unit. And after the issuance date, then the bonds can trade on the secondary market. And just like the forces of demand and supply, the price would go up if there's a lot of demand for the bond, and the price can go down if there's less demand for the bond. So the prices change throughout the life of the bond. So this leads me to the yield on the investment. So for example, the yield is the return that you expect to earn on an investment, or a bond in this case, for instance. And this is why we tell clients to pay more attention to the yield on their Eurobonds, or the Eurobonds that they plan to invest in, rather than the coupon, because the yield could be higher or lower than the coupon. The coupon changes, and the coupon is usually fixed in the Nigerian market. So focusing mainly on Nigeria, the coupons are fixed, but the yield changes depending on the price. So the way the yield and price works is, at a higher price, the yield of your investment goes down because you're paying more at initiation. So if a bond was issued at 10%, for instance, and the price has gone up to 105, then you will not get that 10% coupon unless you bought at 100 when it was issued. So if you buy at 105, the yield could be maybe around 7%, depending on the term to maturity of the bond. And so this yield goes up or down. As I said, the yield could also be higher than the coupon if you're buying the bond at a lower price. So if you're buying the bond at, let's say, 95, the coupon at initiation was 10%, then your yield could go up to about 13%, just as an illustration. Another issue, another feature of Eurobonds is the face value. And this is the amount that you get at maturity. And then the last feature of Eurobonds is the maturity date, which is the date that principal and interest will be paid back to investors. So I've spoken about the features of Eurobonds. And on the next slide, I will talk about the types of Eurobonds that are common in existence at the moment. So we have the floating rate Eurobonds, where the coupon changes depending on a fixed and depending on a floating rate, such as the London Interbank offered rate, which is the rate at which banks in developed economies borrow money between themselves. So on each coupon date, whether it's 3 months or 6 months, depending on how the bond was issued at initiation, the coupon rate resets depending on the rate of LIBOR at that particular date. So for bonds like that, the coupon rate changes over the life of the bond. So if the LIBOR rate increases and there's a fixed rate of about 2%, so they're usually around, let's say, 2% plus LIBOR. So if LIBOR goes up, then you earn more income. If LIBOR goes down, you earn less. And we also have zero coupon bonds, which do not pay coupons for the life of the bond. They are just bought at a discount. So similar to treasury bills, they're bought at a discount, and then you receive maturity, the principal at maturity. So you could buy the bond at, let's say, $95 per unit, and then receive 100 at maturity. So that represents your return on your investment. And we also have convertible bonds, which give the issuer the right to be able to convert bonds to equity at a particular date set in the future. And as I mentioned before, we have the straight bonds, which is what we have, which is very common in Nigeria, which has fixed income or fixed coupons for the life of the bond. And at maturity, you get your face value together with your interest. We also have callable bonds in the sub-Saharan Africa space, which gives the issuer the ability to pay investors back before the bond matures. So I've spoken about the types of Eurobonds that are available. And on the next slide, I'll just talk about what drives the prices, because I mentioned before that the price can go up or down. So what drives returns and prices of Eurobonds? The list is almost endless, although some factors have a greater importance or a greater impact on the performance of Eurobonds. So market conditions could have a positive or negative impact on Eurobonds when they are trading in the secondary market. For example, optimism about the health of the economy, about the global economy and emerging markets, oil prices. We saw what happened with oil prices in Nigeria. That affected us as well. The general economic condition of the country is assessed by investors, and they look at the ability of the issuer to pay back, and that determines whether investors will come in or leave the market. Another factor which we've been seeing recently is central bank intervention, which has helped to support markets on a global scale. And so that's helped our markets because the central bank has been pumping money into the system in global markets, and that has helped to cushion the effect of the COVID-19 pandemic. So that has also helped to support markets for the meantime. Another factor that affects the return on Eurobond is the term to maturity. So typically, when Eurobonds are nearing their maturity date, the price tends to go towards the par value, especially if there is no expectation of a default, for instance. But if there's an expectation of a default, then that rule may not always hold, depending on how how bad things are in the country. But on a typical situation, when payment is expected at the right time, then the bond price tends to go towards the maturity value of 100. So for instance, if you bought a bond at 103, you know that at maturity, you get the bond at 100. However, that doesn't mean you're making a loss. It depends on how much time there is between when you buy it and when the fund goes to the bond is about to mature. So if you have enough time to get enough coupons, that can offset the capital loss that you make on buying at 103 and then collecting $100 at maturity. Another factor that affects the performance of Eurobonds is the underlying currency. So if there's expected to be a shock in the currency to the downside, the currency that the Eurobond was issued in, then you may see investors selling off on that Eurobond in order to protect the value of their funds. And another major factor is the yield differentials. So the difference between yields of investors in foreign markets and in the markets and in the issuers country, or the rates that are offered by the Eurobonds, then the more demand you would see, because investors will look at the differential income they could make, so they could borrow in their own currency or country at lower rates and invest in higher rates in emerging markets, for instance, which is what we've been seeing over the past few years in the sub-Saharan Africa Eurobond space, with foreign investors piling in just to get that extra return on their investments. So moving on to the next slide, spoken about the drivers of performance in sub-Saharan Africa Eurobonds. The list, as I said, is not exhaustive. And so here I'll just quickly run through the history of Eurobonds in sub-Saharan Africa. In 1990, that was when we had the first issuance of a Eurobond by South Africa. And in 2007, the story continued in earnest, with other countries joining into the Eurobond space. There was a gap in 2008 and 2009, understandably, as no investors would look our way during that period, given the financial crisis. And in 2014, we had 17 countries which issued Eurobonds. And right now we have about 21 outstanding Eurobonds from different issuers across Africa. Last year, there was about $17 billion issued in Eurobonds across the African region. And that just shows the level of interest that Eurobonds have from foreign investors. So the three biggest issuers are South Africa, Kenya, and Nigeria. South Africa has the longest curve, but we have in Nigeria quite a nice curve in the sense that we have multiple maturities of our sovereign Eurobonds, which investors can pick depending on their time, on their investment horizon. And we have other single outstanding issuers, as well as middleweight issuers like Ghana, Angola, and Zambia. So on the next slide. All right, so this slide just shows I just want to talk about what has happened in the market this year. So it shows on the gray bar shows the lowest price that these select bonds have gotten to this year, and the blue bar shows where they closed at as at H2 2020. As you can see, all these bonds experienced losses or experienced drops in price due to the COVID-19 pandemic. Oil price crash also affected issuers. And what is apparent here is countries like Nigeria and Angola saw more significant dips in price. So the 10-year Nigeria bond got to a price of $64 per unit, and now it came back to 100. And as a result of optimism around, economies coming back to business and demand for oil picking up, we saw a reversal in the sell-off. So March was a very intense period of sell-off from foreign investors due to panic around COVID-19. So all producers, especially after oil crashed, all producers saw a more significant impact on their bond prices. So countries like Kenya, Ghana, Senegal didn't have as much of a reaction in terms of price. So Angola, which is a major oil producer, well, the economy is mainly based on oil. They saw their prices reach $38. So that's almost about over 20% in terms of return for the 10-year bond. And that just shows the level of selling, because the bond was previously at 90, 100 levels, but it went down to 30 because there was a lot of concern around their ability to pay back. But after they got a moratorium of debt repayment from China, there was a bit more faith in the country's ability to pay back, although they're not quite out of the woods yet. So they've been the best performers this year. Assuming you bought their bond in January when it was almost, when it was at $30 levels. So moving on to the next slide. So in this slide, I'm talking about Nigerian Eurobonds specifically. So the first three sets of bars talk about the bank Eurobonds, and you can see the price change between the lowest price and the price at the end of each two isn't that significant, and that's because of another factor that affects trading, which is liquidity. So because these bonds are not that liquid in the sense that there's not so much of the bond in circulation for people to trade with. So the prices don't move as much as the sovereign Eurobonds. So Nigerian sovereign Eurobonds are quite liquid in that people can buy and sell at any time. But bonds that are not as liquid, it's not as easy to find buyers or to find sellers as well. So we've seen that for the longer dated bonds, and that's another factor with bonds. The longer the maturity, the more risk and the more sensitive the bonds are to changes in interest rate dynamics. So if you look towards the right, the longer dated bonds in Nigeria, bond maturing in 2031, went down to 64, but we've seen a recovery ever since optimism around economies going back to business came up. So while there's still some risks, especially around COVID-19, we expect that the market should remain. So what we've seen is after the rally, which was very significant, we didn't expect it to even happen this quickly, but it has. So after that rally, we've seen a bit of a quietness in the market now. Investors aren't really piling on. There's still a lot of uncertainty about what's going to happen next. So the market is almost driven by headlines at this point in time, where any good news on COVID-19 would help to push the markets up, which is what we've been seeing really. So the outlook for oil prices is still affordable, or is still is good for Nigeria, around $41 on the average for H2. So that should help investors gain more confidence around Nigeria. So even if we do see a pullback, we shouldn't see anything too significant in terms of losses on our Eurobonds, or nothing, or nowhere near as significant as what we saw in the month of March and April. So on the next slide, so I'll briefly talk about the benefits and constraints of investing in Eurobonds. And as I mentioned before, Eurobonds offer diversification from a currency perspective. You're earning interest on your dollars rather than leaving it in your domiciliary account earning nothing. The fixed income payments on Eurobonds help investors to plan, and they know what to expect at each point in time. It also gives investors trading opportunities. For example, what happened in the months of March and April, investors who came in at that time would have made a lot of money now because the prices of bonds have recovered during that period. A major constraint for the investments in Eurobonds is the minimum trade size. So the minimum trade size is a face value of $200,000 per Eurobond. This doesn't mean that the investor will pass $200,000, but it depends on the price of the bond. So you could pay more or less depending on the price of the bond, but it's usually around that $200,000 mark. And there's market risk involved. The price of the bond could go up or down, as I mentioned, depending on the factors that I mentioned earlier around sentiment of ability to pay, what's happening in global markets, shocks in commodity prices, which are directly related to the economy of the issuer, and so on. Another constraint or disadvantage of investing in Eurobonds is the concentration risk. So unless investors have a large portfolio where they can buy multiple bonds, there's a lot of concentration risk buying one bond. If anything can happen, investors could, especially in situations where, let's say, an investor wants to sell their bond before maturity for some urgent needs, then they may be caught at a bad situation, because if the price of the bond has gone down, then all the investments would have gone down at that point in time. So these are factors to consider. So in this presentation, I've talked about Eurobonds, features, types, what's been happening in the markets, and these constraints, as I mentioned, would exclude a lot of investors from investing in Eurobonds. However, FBNQuest Asset Management has the FBN Nigeria Eurobond Fund. So with the issue of minimum trade size, the Eurobond Fund takes care of that by allowing investors to invest $2,500 in the fund. And the fund is a mutual fund, it's an open-ended mutual fund, which has exposure to a vast array of assets that are issued by Nigeria and in Nigeria. So we have multiple Eurobonds in the portfolio from both corporate and foreign, the federal government of Nigeria. And so this gives diversification in the sense that if one particular bond goes down, then the other bonds in the portfolio can support. So therefore, it reduces the risk to investors. The fund also has exposure to fixed deposits, which also helps to cushion the effect of losses on Eurobonds, for instance. And these are assets that investors would not, or investors with lower amounts of money would not have access to ordinarily. So that's the advantage that the fund gives to our investors. However, I should mention that the fund has a long-term investment horizon. So investors are expected to have about 3 to 5 years horizon because the fund is marked to market. So we pride ourselves in showing and being transparent. So we show the current value of investments at each point in time. So that means that the value of investments can go up or down based on what's happening in the market. And what we saw earlier this year in the months of March and April was a dip in the fund's performance because of what was happening in the market. However, we were able to reposition the portfolio and take advantage of the lower prices in the market with new inflows and moving from placement securities to Eurobonds. So we're able to come out of that lull in performance. And the fund has achieved a 1.1% return so far this year. But since initiation, the fund has achieved 35%. The fund was launched in 2016. So if you invested $100,000, for instance, in the fund in 2016, and the value of your investment now will be $135,000. Our returns are quite competitive, and I dare say better than those of the our competitors. There's still room for the fund to run. As I said, with the outlook for Eurobonds, even if prices don't go up as much, you can still, based on the assets in the portfolio, you can accrue income and then give investors competitive returns. So last year, the fund did 10% on dollars, for instance. And another thing I would mention is during times of uncertainty, when, in the months of March and April, when the fund got down to, negative territory, an investor that came into the fund in March would have achieved a return of 12%. So it depends on where you come into the fund and what's happening at that point in time. But if you started the fund at the beginning of the year, you'd have achieved a return of 1% because the fund went down and then up. So the timing of entry also affects the return of investment, the return on investment that investors gain. So monthly fact sheets are sent out showing the asset allocation, what's happening in the markets, and how and the portfolio manager's outlook on performance as well. And with this, I have spoken about another alternative, which I think is useful for investors that don't have the minimum required amount for investments. And I think I would tell investors with dollars just sitting around in that, their DOM accounts to invest in the FBN Nigeria Eurobond Fund and earn competitive returns on their dollars. I would hand over now back to Isabel. Thank you so much for listening.
Thank you so much, Adeyemi. That was another very insightful presentation. Thank you all again for listening. I believe that we all now understand how we can diversify our portfolio by investing in Eurobonds, either directly or indirectly through a mutual fund. So, and then earning good returns on your dollars rather than keeping them in your domiciliary account. At this point, we're now going to be taking questions which we have received in the chat room. So if you haven't sent your questions, kindly send your questions into FBNQuestions chat room. So my first question is going to Adeyemi. A participant asks, the current yield from Eurobond investment has been observed to drop relative to 3 to 4 years back from trend. Do you see this to likely improve?
Yes, so as I mentioned before, the drop was because of the COVID-19 and oil price shocks. And before I ended the presentation, I said that we expect that the fund should improve or should continue to improve as long as we don't get any significant bad news from the COVID-19 outbreak. But as I said, foreign central banks have helped to support markets and provide liquidity for investors. And then as long as our investments still offer attractive returns to investors, we should still see them coming back to the market and helping to support returns. So I do see the fund returning back to the previous returns that we've achieved in previous years.
Okay. So still on you, Adeyemi, we have another question. The participant is asking to know what amount is required to bid directly than bidding through the banks with smaller funds.
Okay. My interpretation of that is the minimum amount. So I would just answer that in two ways. So if you were to buy Eurobonds directly, you would need about $200,000 in terms of face value, which I said can be higher or lower than that figure depending on the price. But you need around $200,000 to gain access to direct Eurobonds. However, for the Nigeria Eurobond Fund, FBN Nigeria Eurobond Fund, you need $2,500 to gain access to that.
Okay. So Chinwe, this will be for you. Please help to reconfirm the end of year FX forecast.
Okay, thanks, Isabel. Yeah, so the our end year forecast for the exchange rate is 410 naira per USD. And there's so many factors to consider when coming up with the projection. I'll just mention two, which I talked about during the presentation. You have the oil price, and you also have the external reserves. And as I mentioned, we are seeing, or we expect a shoring up on the reserves on the back of loans from multilaterals, which would give the CBN some room to defend the Naira. And also, all prices are picking up. Of course, they're not at pre-COVID levels yet, but at least the trend of consistent falling has been halted. We're seeing it pick up. We're seeing it late 30s, 38.40 now. So in our opinion, we believe that the CBN would do all that it can to manage the exchange rates until it has no more room to maneuver. So our forecast is 410 naira per USD for 2020. I hope that helps.
Thank you for that, Chinwe. So Adeyemi, I have another question for you. Does the Eurobond fund operate like the money market fund, where your capital is preserved while you earn interest in it?
Okay, thank you. That's a good question. So similar to what I said during the presentation, the price of the fund is determined by the performance of bonds in the portfolio. So if the bonds in the portfolio are going up, then the price of the fund will go up. If the bonds in the portfolio are going down, the price of the fund would go down. However, we still have placements or fixed deposits that help to cushion that. And of course, the portfolio manager is managing the portfolio actively. So we're there to pay attention to markets and try and be proactive in terms of protecting the portfolio from any losses. So it's not similar to the money market in the sense that income does not accrue on a fixed amount. The price of the fund, the return is based on the performance of the bonds in the portfolio.
Okay, thank you for that. So as a prospective investor, how do I invest in Eurobonds when my income is in Naira?
Well, so I mean, we would advise clients to source for dollars and then transfer to us so that we can invest in or buy the Eurobond of the client's choice. We currently don't provide dollars to clients, so the clients would have to transfer dollars to us in order to purchase Eurobonds on their behalf.
Okay, so how is the account funded? Can one transfer directly from his or a domiciliary account to the Eurobond fund account?
Yes, you can transfer directly from a DOM account.
Okay. How do you intend to improve the transparency in the fund mandate for the fund managers, as well as timely reporting to fund subscribers?
Okay, so on that, we have a fact sheet which is sent to clients on a monthly basis and shows the performance of the fund during the period. It talks about what happened in the markets, the asset allocation as well, and the previous returns that were paid on the fund, as well as the portfolio manager's outlook on the fund. So if you haven't been getting that, then you may want to contact your relationship manager. But we do send fact sheets on a monthly basis to keep investors up to date on their investments and what's happening in the market. Same thing for all our other funds.
Okay. I'll take this question. As an FBN account holder in the fixed income fund, do I need to open a new account to invest in the Eurobond? So if you're an existing investor in any of our mutual funds, you're not required to open another account to invest in the Eurobond fund. All you just need to do is contact your relationship advisor or our customer care unit, and you would be and indicate your interest in investing in the Eurobond fund, and then they will guide you through how you can transfer the funds and set up your Eurobond fund investment. So for an existing investor in any of our mutual funds, you do not require to open a new account. Another question I'm going to take, I have some funds domiciled in my Bank of America account. Is there a way of investing in the Eurobond fund from a foreign account? So as Adeyemi had earlier said, you can invest in the Eurobond fund from anywhere in the world, anywhere you're residing in the world. All you just need to do is go through the standard procedure to set up an account with us, a mutual fund account with us, and you can then transfer funds from your bank anywhere in the world into our Eurobond fund account. That being said, if you, for any other inquiries, if you want to know how to go through the process of setting up a Eurobond fund account with us, you can send an email to us at webminers, that's WEBINARS at FBNQuest.com. So thank you all. We have now come to the end of the Q&A session. I want to believe that everyone has been highly impacted by the sessions today, and you've all learned one, two, or a few things. You know, with the presentation by Chinwe, where she gave us an overview of the economy and projections and how you can tie this into your individual investment portfolios, and the presentation by Adeyemi, where he covered diversification opportunities, the need to invest in dollars through Eurobonds, which you can do directly and indirectly. Thank you all for joining this maiden edition. This is our first and maiden edition, and we really, really thank you for making this a success. Leading Conversations with FBNQuest is going to be a periodical webinar series that we're going to be having, and we hope that you're going to be able to join us for other sessions. I do believe that you found this very informative, engaging, and I believe that you're going to be able to act on the things that you've learned today to further enhance your financial situation. Note that the presentation for Chinwe will be shared via email to all the attendees of the webinar today. Do follow us at FBNQuest on our social media platforms, Twitter, Facebook, Instagram, LinkedIn, whichever of these platforms you use. Follow us so that you don't miss out on other upcoming sessions. If you still have inquiries, if you have questions, if you want to know how you can start investing, if you want to, any other question you basically have, if you want to reach out to an investment advisor, if you want to reach out to the team, please send us an email on webminers spelled as WEBINARS. Please reach out to us on webminers@fbnquest.com, and we will attend to your inquiries. Do have a great day, everyone, and stay blessed, and stay tuned for more information on other series. Thank you.